Hey guys, so Dan from Trading with Dan here, and today we're going to look at range trading. So when price action is trending, say trending up for example, then you often get an impulsive move up followed by a shorter corrective move down, then followed by another impulsive move up, like you can see in this example here. We have the impulsive move up. This will likely be on high volume like we did in the volume video, followed by this corrective move down, which would likely be on low volume, and then when volume comes back in, we then continue the trend back up with another impulsive move up. It will also be likely that a series of higher highs, a high here and a high here, and a series of higher lows, so a low here then a higher low here, will be formed in that trending up price action. Once trending up or down price action stops, then what we have is called an equilibrium, and that is when range trading can be very profitable. So here we can see in this asset, we've got the price comes down to this level here, 0.1. So we were trending downwards. We'll assume we were trending downwards. We came to this 0.1. We then retrace back to 0.2, which is fair enough. That's just basically a lower high. And then we come back down, but we don't make it back below level 1. And we pivot. So we can kind of see that we've sort of lost this downtrend, and then we get a move up above level 2 to level 4. So what it actually looks like, we're starting an uptrend. So we have this low, this higher low, we have this high, and then this higher high. But then this is a point that we then know we are no longer in a downtrend or an uptrend, and we are range trading, because this level here, the price action comes from level 4 and goes below level 3. So we're definitely not going up and we're definitely not going down. Therefore market is in a state of equilibrium, and we are then going to range trade like most likely for a bit. So then what happens, we do come back up to this level, but we just basically get rejected and we come back down. We come back towards the bottom of the level, towards the low of the 1, and then we come back up again, come back down to that low level, come back up again, come back down, and eventually we do take out that low level and then resume the downtrend. But for this point in time here, we are no longer in a downtrend, not in an uptrend, and we are basically range trading. So consolidation. Often ranging price action is a consolidation of an overall trending move. It can be at the end of a current overall trend, but price action must prove to you, and it would be unwise to assume that is the end of the overall trend. So what that means is you can get a consolidation, get some range trading at what could be the end of a trend, a trending move down for example, but you need price action to prove to you it is the end of that move down, because remember, the trend is your friend. So that is a general rule, because markets generally keep trending, so you have to give it the benefit. You have to basically let it prove to you that it is the end of that trend. So the 4 phases of market are accumulation, markup, distribution, and markdown. So what it is, so say we're trading around a level here, that's called that could be an accumulation, and then price moves up, so that would be the markup, and then price will then consolidate at that high, that can be distribution, and then we come back down, and that's called the markdown. So ranging price action can be either the accumulation or the distribution part of that. So it could be either the accumulation where we're then going to move up, or it could be the distribution where we then move down. So you have to be patient and let the trend prove if it is indeed going to reverse. Look for higher time frame divergence and assume the current trend is going to continue if the consolidation is only occurring on a smaller time frame. So obviously there are risks involved in range trading. They can be limited though if a trader is disciplined and can identify behaviors in price action and volume action. Traders can mistakenly think a level gets stronger the more it gets tested, but we've looked in a few of our previous videos and we definitely know that isn't the case, such as with ascending triangles and descending triangles. Remember the section on liquidity pools and what can happen as more traders place their stops at a specific level. Price action can eventually be forced to break through it to create liquidity. The key is not to blindly enter a position simply as price has moved into an area it previously got rejected at. Also don't assume price is going to break out as it moves towards a strong resistance and breaks out above it. So obviously here we got an expanding trading range, so this kind of shows what happens if price does break out but then just comes back in. So when a price breaks out of the range but fails to trend, then you have an expanded trading range. So basically just here was the range and it is now expanded to here and here. So attempting to trade this pattern is actually not advised, as it infers market indecision and therefore not really giving you any edge when it comes to predicting the outcome. So if you're range trading it and you were buying here or selling here, you don't really know if the move is going to continue up or continue down. The point you should have either bought if you wanted to buy was here, and then you could have your stop there, and if it comes back you stop out, and if it keeps going you're already in the trade. So just remember, breaking the trading range does not always indicate price action is going to resume trending. It may just be an expansion of the range. Right, so this brings us to range trading indicators. So range trading indicators, such as this one here called the range and stop, can be very useful if you want to profitably trade the range. And remember, a lot of the time the market on like a medium or even a higher term time frame can spend a lot of time range trading, more than it can sometimes be trending. So range and stop is an indicator we've produced for this exact purpose, and it is very good with its smaller and larger time frame ranges for you to identify. So I'm gonna bring this over for you guys to have a little look at the range and stop. So this is the current price action now. So you can see here we had a trending price action. We can see we're moving up, and then we sort of got to a range where we stopped going up, and then you can see the larger term time frame will identify this as sort of a low that price would probably get to and bounce back. And then we also have this smaller one, but the smaller one will obviously move around a bit. But you can see here, once we actually get into the proper equilibrium here, after we've had the move up, we sort of had a bit of volatility and then we've calmed down. You can kind of see we're at the bottom, the top, the bottom, the top, and then we broke through the top but came back in, and then we're now at the bottom and we broke through the bottom. So you can see this is a really good range trading indicator that you can actually purchase from us. So right, so that's it guys. So thanks for listening to that video, and I will catch you on the next.